Hello and welcome everyone to day two of the 2024 US Expats Finance Conference, brought to you by AmericanExpatDirectory.com and sponsored by Expat Focus, the web's favorite destination for anyone moving or living abroad. We have a fantastic schedule for you consisting of 9 sessions over 3 days, covering multiple aspects of financial information for Americans living abroad, with perspectives from some of the world's foremost experts in their fields. Today is the second day of the conference, and for this, our third session of the day, I'm delighted to be joined by Tom Zekaistel of International Asset Management, who will be talking about investment environment and themes for US expats in 2024. Before we start, though, please bear in mind that the information presented is for general educational purposes only and you should always seek your own personalized financial advice. Tom will be answering your questions at the end, so please add them in the Q&A pop-up at the foot of your screen whenever you think of them. We'll try to get through as many as possible, time permitting. So without further ado, let me hand over to you, Tim.
Okay, well, very nice to meet all of you virtually. And I'm sitting here in our offices in San Mateo, California, which is just south of San Francisco. I've got my coffee because it's 8 a.m. here. My International Asset Management coffee mug, very rare, only a few of them on the face of the earth. And I'm going to have a number of slides to share with you, but hopefully we'll keep it interactive mostly, and at the end there'll be time for a Q&A. So if everything goes right here, let me share my slides like that. And you should be able to see that now. And so let me just get a couple things organized here. Good. All right. So investment environment and themes for US expats in 2024, right? And that's me. So I'm a chartered financial analyst, a little background, a certified financial planner. I started this firm in 2002. The name of the firm is International Asset Management. We're based in the San Francisco area, but we have clients in over 30 countries. What's a bit different about our firm is that 90% of our clients are US expats, Americans living abroad. The other 10% are probably people who have worked in the States. Maybe they have U.S. retirement plans, and they've moved back to their country, to another country. And we offer services around two themes: investment management and financial planning. Today, we're going to be talking more about the investment management side of things, more about what's going on in investment worlds and markets these days. A little bit about me, like I say, chartered financial analyst, which is a portfolio management credential, certified financial planner. I used to be the president of the San Francisco Financial Planning Association. I was an expat myself in a dozen countries as an engineer for Schlumberger in a previous career, and I've been managing investments for U.S. expats for about 20 years. I started this firm in 2002. So this is what we're going to talk about. First of all, the big investment theme, I guess, this year is interest rates, right? Interest rates going up, how that has affected bond markets and other investment markets. More like the old normal than the new normal because interest rates are not that high compared to historic. We're going to talk about stock markets, U.S. markets, other developed markets, but also emerging markets, off the beaten path a little bit. And then another theme that maybe is in the background that not a lot of people have been tracking, but it's certainly been out there, is value versus growth companies. Because value companies are more like, in the stock market, the more companies that produce dividends. Growth companies are more like your technology companies, not so much in dividends, but high growth. So you expect the prices to do better. We're also going to, and there's been a big, say, disjointing where growth has outperformed value for many years now. So we're going to talk about that. We're also going to talk about other things, not just stocks and bonds, and maybe a little bit about the future, what works in terms of forecasting and doesn't, A look at some themes, investment themes. Also for many people, especially if they're retired overseas, how to get income from your portfolio. It doesn't just have to be dividends and interest. There are various other ways and various other products other than bonds and dividends from stocks. So we're going to have a look at that. At the end, we'll look at some U.S. specific expat issues. So you'll want to hang around for that. And as we go along, there'll be little tidbits of special info and in many sections, things that maybe you don't hear from the average portfolio manager or financial advisor. And there's going to be some actionable info also that you may not hear elsewhere. We're going to be talking about expat issues throughout, not just at the end, and also a few fun facts, I hope. But stay tuned for the last section. If you're an American living abroad, this will be something that you probably want to hear about. And finally, if you're not completely satisfied with the presentation, then send me an email and I'll give you your money back. All right, so let's move on. Let's start with the interest rate world. Obviously, higher interest rates and very suddenly higher interest rates as well. So the Federal Reserve, we're talking about US interest rates, but this is also somewhat true in Europe and in other places. So in the US, the Federal Reserve has raised rates very quickly from pretty much zero to just over 5% within, essentially 2 years, mostly in 2023. And so how has this affected markets? We're gonna look at it in a minute. But first of all, let's have a look at a historical perspective, because everyone's talking about these high rates and, oh my God, when are they going to come down? Is it gonna choke off the economy and so on? But let's keep things in perspective. So this is a chart going back to the 50s, which is even before my time. And you can see that a 5% rate is not huge. I mean, for anyone who's been around a long time, maybe you can remember the 80s when interest rates were very high because we had inflation. There was those were the OPEC years where the cost of fuel went up a lot and mortgage rates were at 15% and stuff like that. So we are not in an era of historically high rates by any means. Really, the Fed has done a great job. The Federal Reserve has two basic mandates, low unemployment and low inflation. And in the US, we have very low unemployment, almost historically low unemployment, and inflation has now come down as well. So I think the Federal Reserve has done a great job. There are some people out there who even want to fire the chair of the Federal Reserve. Well, those people don't know what they're talking about because they've actually done a very good job. So let's keep things in perspective. We are not at a historically high rate for interest rates. The economy in the US is doing well, not so well in Europe, I don't think. So they have bigger issues there. And then, in other parts of the world, it's kind of variable. But in the US, we're doing okay. So why do we even talk about interest rates? It's because there's this thing out there called the yield curve. And the yield curve is the amount you get paid on bonds of different maturities. So this is the US Treasury yield curve back in 2021. Remember, interest rates were practically zero back then. And so if you look at the chart on the bottom here, and you look at this area right here, you can see it goes from like 1 month, and then here we're at 2 years, and then here we're at 10 years, here we're at 30 years. So basically, that yield curve was very flat, and then it went up, but it only went up to about 2%. Even at 30 years, you could get a 2% in a 30-year government bond back in 2021. And so what happens when interest rates go up? Obviously, this yield curve is going to change. And it's going to change, here's 2022, mostly on the short end. On the long end, see how it started going up at 1 year? Now we're at 1% at 1 year. Before we were at 0 in 21. But on the long end, we're just over 2%. Remember, we're at 2% a year ago. We're still just over 2%, really. And then when interest rates really started going up, in 2023, when they went up so quickly, then we had a huge response on the short end, and you could get maybe, 4.5% out to about 6 months, 1 year in a treasury bond. But the 30-year, it went up too, but it only went up to about 3.5%. And so now we have what's called an inverted yield curve. And here's what it looks like today. Here we have now over 5%, over about 5.5% on the short term, a 3-month bond, treasury bond, and on long end has started coming up too, but we're still only about 4% there. And so many people talk about an inverted yield curve, maybe yields to a recession. Well, we've had an inverted yield curve for a while now, but it is something to be aware of, because what it's saying is that people don't want to lock in their money for long periods of time, basically, at these interest rates, right? And so what can you actually get in a bond these days? This is from one of the firms we use, Charles Schwab, to hold our clients' money. And these are the actual interest rates you can get in various types of bonds. And you can see, so if we're looking at US Treasuries, the standard US Treasury bonds, at the short end, 3 months, you can get about 4.3%. And then at the longer end, you can get maybe, here, let me bring up my pointer. The short end, you can get about 5.4%. And then at the long end, though, you can only get 30-year Treasury about 4.3%. So inflated, but inverted, but very different from just a few years ago. A few years ago, it really didn't make sense to invest in bonds. And now maybe it does, especially since, as we'll see, bond prices go up if interest rates go down, which is the more likely scenario these days. The other thing is, when you get into corporate bonds, you can get a much higher, well, a somewhat higher rate on the long term. So this, for corporate bonds, the curve isn't as inverted. So you can get maybe 5.5%, 6% in a 30-year corporate bond. That's a bit about bond yields. What about interest rates? This is the other custodial firm we use, Interactive Brokers, and they actually pay a decent rate of interest on various currencies. So you can see on the US dollar, for example, you can see they'll pay about 4.8%. And then you have various other currencies. So these are on cash balances. You don't even have to put your money into a bond. You can get 4.8% at Interactive Brokers. These are our rates. These are retail rates if you invest your own money. And then even something like euros, 3.4 pounds, 4.7%. I mean, the caveat is that they don't pay any interest on the first $10,000 or equivalent. So that's how they make their money, I guess. But still, pretty good rate of return, even on cash products. And this isn't just Interactive Brokers. There are other brokerage firms that are doing similar things. But you have to be careful, because sometimes when you have a cash balance, we have a cash balance at Schwab, they're not paying anything on that, I don't think. So at Schwab, you probably want to invest in the bonds. Other ones, you can maybe have a money market or something like that you can put your cash in, your safe money, that kind of thing. Interactive Brokers, by the way, is great at dealing with expats. It's one of the few U.S. brokerage firms that will deal with Americans living practically anywhere. But they're not very user-friendly, and there are some quirks on the investment side as well, but we'll talk about that later. Schwab also is good at expats, but there are some places that they will not cater to. They don't like to deal with people in France or Italy or the Netherlands or New Zealand and a few other places. So there it's country specific for Schwab. Philippines is another one they don't cater to. So you have to be careful with them, and most of the other U.S. brokerage firms. That's one of the big issues these days, is they don't want to deal with expats too much anyway. So moving along, another one is Wise. So Wise is a currency transfer service, and more they're positioning themselves as a bank, actually. They pay a good rate of return now on some of their cash deposits. So Wise is something you might want to consider. It used to be called TransferWise. If you want to do currency transfers and exchange, and maybe you don't have an Interactive Brokers account, so they're a pretty good alternative, and you can even use them as a bank these days. They are, by the way, publicly traded on the London Stock Exchange, And we're not giving investment advice here, but here's how they've been doing, and they seem to be doing pretty well in that field. More and more people are opening Wise accounts, so that might be something to look at as well. Now, one caveat, Wise USA, I have a Wise account, and they seem to use a bank called Community Federal Savings Bank. So I looked it up, and here it is. This is in Queens, New York. This is off of Google Maps. I live on the other side of the country, so I haven't actually been there. But if anyone of you lives in New York and wants to go check this out, I'd sure like to know how this little bank caters to all these Wise customers. So that's one thing to think about. If you live in an emerging market country, then maybe you're used to this kind of thing anyway. I mean, I spent 2 years in Nigeria. I remember when we used to buy used to go to the travel agent and buy tickets out of the country, and they cost about 60,000 naira, and you had to pay in cash. And the largest bill was, I think, a 50 naira note. So you had to go with like over 1,000 of these. You went to the bank and they gave you 10,000 naira bundles tied with twine and put them in a paper bag. And, you're the only white guy on the street walking around with his bag of money to the travel agent. So that was a great experience in Nigeria. I'm sure many of you have experiences like that as well if you live in some of these more exotic countries. Okay, let's get back to on topic here. So interest rates versus bonds. Generally speaking, interest rates go up, bond prices go down. And we can see this if you look at this chart, which goes back to, say, 2005. You can see that, especially lately during this last upturn where interest rates went up very quickly, the orange line is the U.S. Treasury 20-year, so long-dated Treasury bonds, and it's a bond fund, bond exchange traded funds. And you can see how the price of that went down dramatically in 2023 when interest rates went up. And you can see how the price of that went up dramatically when interest rates came down, in the 2019, especially 2020, when we got into COVID there, the Fed lowered interest rates very quickly. So this is actually a very volatile investments. And this is how you make money in investments, because you know that when interest rates go up, bond prices go down. That is, maybe it doesn't happen every time, but it's the way to bet for sure. It's not like the stock market where you have to try to figure out if a company's going to make money or not. This is kind of a given. And so this is also how financial advisors earn their fees, by knowing this kind of thing and not putting their clients into long-dated bonds when interest rates are at zero. But now is the time to think about these bond investments for more conservative investors. So if your investment advisors had you in long-dated bonds when interest rates were at zero and going up, well, then it's time to think about who else you might want to deal with. Here's another chart of stocks and bonds and interest rates as they went up. So this is basically from 2020, and the yellow line is the S&P 500 index. It's up about 30%, and you can see that the long-term Treasury bonds were down about over 30%, 38%. The blue line in the middle are short-dated Treasury bonds. So if you were in bonds, that would be the place to be when interest rates are going up, because they're not as volatile. So you can see that the long-dated bonds are as volatile as the stock market when these interest rates are moving. So that's something that's important to bear in mind. It'll work the other way too, by the way. When interest rates start going down, you'll see the prices of those long-dated bonds move much more to the upside than the short-dated bonds. And that might be the time when, say, we're getting into recession and the stock market might be going down too. So there are some diversification benefits to holding bonds most of the time. Or better yet, in terms of diversification, how about a portfolio of other income-producing investments, if that's what you need, if that's what you want, income, something that's maybe usually a little more conservative than the stock market, not always. But there are other income-producing investments. So there are a number of graphs here. Don't try to see them all, but the point is that here we've got things like say high yield bonds as well, which pay a higher rate of interest, but they're more closely correlated to the stock market. They were up, say, over this time period when interest rates were going up. They were up a little bit, maybe about 3%. Dividend paying stocks, like there's the Vanguard High Dividend Yield Exchange Traded Fund was up about 10%. So business development corps, that's the green line, that's at the top. Actually, that was up about 14%. Business development corps are like publicly traded private equity. They're companies that invest in say 100 or 200 smaller companies, and those companies get loans from them at high interest rates because they're the riskier ventures. So these business development corps pay a dividend in the 10% range usually. So there are a lot of, real estate investment trusts are another one. They didn't do so well, but they are another source of income. So there are lots of income type investments that you can use. It doesn't just have to be bonds, and it doesn't just have to be dividend paying stocks. So bonds over the last 10 years, as you can see, quite volatile on the long end. Again, the purple line is the 20-year treasuries. And then you can see how the orange line is like mid-dated bonds, 7 to 10-year bonds. And then the blue line is short-dated bonds, so much less volatile. And then the green line, though, is high-yield bonds. And you can see how those are really not correlated to the rest of the bond market. High-yield bonds are more closely correlated to the stock market. So these are riskier corporate bonds from companies that are not considered to be investment grade. So they tend to go up and down with, they tend to respond to things like recessions, kind of like the stock market. These companies do better or worse, and the risk there is that they might default on their interest rate payments. And that's why those high yield bonds are more closely correlated to the stock market. So that's important to know as a bond investor, because entirely different characteristics, high yield bonds compared to investment grade bonds and especially treasuries. And so here again is our investment markets in general since the interest rate hike. And at the top of that is, the S&P 500 index. And the next down is developed markets. So this is like European markets and so on. They were up about 11%. But interestingly, emerging markets, they were down about 10%. So emerging markets are the blue line. You can see them in the middle there. They're down about 10%. So they didn't do as well. And then the bonds were variable. Obviously, the longer ones didn't do as well. We've already seen that. So this is how markets basically responded. And when interest rates started going up, everybody was worried about how this would affect the stock market and how it would crush the economy. And look, here we are, 20% up in the S&P 500. And here's a longer view since the last big recession in 2008. And obviously, the stock market has done very well, up 700%. The green line below it, up 500%, is actually REITs. So real estate investment trusts, they also did well. And then there's a big gap, and you get into things like gold and bonds and so on. So longer term, if you take on more risk, you do expect to get a higher return, but also with much greater volatility, as you can see. A little bit just to close off on the bond thing. Holding individual bonds for a specific purpose makes sense. Like 3 reasons: diversification benefit, lower volatility, generally speaking, and an income stream. But just like many stocks, bonds have 2 components: a cash flow and a price level, right? And so you have to think about the price level, unless you're buying, especially if you're buying bond funds, which is the way most people invest. If you're buying specific bonds, that's really, in many cases, a better way to go, because you hold them to maturity. You're going to get your money back, unless it's a default. You're going to get your money back, and the interest rates you're going to get. So much more useful if you have a larger portfolio to use individual bonds rather than bond funds. And then bonds respond to different economic events than stocks do. So that's why they provide diversification benefits. Bonds respond to interest rates more so than earnings, for example, or at least for government bonds, not so much for high yield as we've seen. So let's move on to another theme that's been kind of interesting, which is in the stock market, in the US market especially, value versus growth. So value companies are the ones that we buy for the dividends. We don't expect them to grow that fast. You know, maybe a company like Pfizer or Merck, pay a good dividend, lower volatility, reliable income stream, and some growth too. And then the growth companies, you know, there you're talking about technology companies, for example. They don't pay much of a dividend, but you expect their stock price to do pretty well. That's why you buy them. So value versus growth. And usually you get into these areas where maybe for 2 or 3 years, value outperforms and then growth outperforms and that kind of a thing. There's kind of a trade-off. But for 5 out of the last 6 years, growth companies have outperformed, and that's really historically unprecedented. And so that's worth mentioning because as an investor, we need to think about, well, is this going to continue or is there going to be a reckoning? And why has that been? Well, mostly it's because of the performance of technology companies. Look at these technology companies since 2009. We're looking at the S&P 500, which is done pretty well, up 500%. That's the line at the bottom, the purple line. But then we're looking at Apple, Microsoft, Google, Amazon. Those are the other ones. And look how much better they've done. And they've really been driving a big chunk of this investment market upwards. And they've just outperformed dramatically. I guess that's not really news, but the question is that going to continue? But look at the volatility as well, you can especially see it in the top two, right? The top two are Apple and Amazon. In 2002, they were down dramatically. 2003, up dramatically. And in fact, let's look at that. In 2002, here's a chart of the S&P 500, which was down about 20%. That's the purple line at the top. But these other technology companies, here we have Apple, Microsoft, Google, Alphabet, Amazon, and Meta, Facebook. Facebook's the one at the bottom, Meta, down 64% in 2022. And then in 2023, wow, Meta's up almost 200%, and the other ones are up big too, 80% for Amazon. Even the S&P was up 25%, but these things were up more than double. So big volatility, but very big return since 2009. And if you look at the last 3 years, here's the interesting thing: you look at value versus growth, and really, they're pretty much the performance over 3 years has been very close. Most of the time, value has actually been ahead. Growth is slightly ahead at the end, but by 7%. But you can see the difference in volatility between the value and the growth. And so you need to think about, as an investor, what kind of investor are you? Are you more of a growth-oriented investor, or do you want to be a little bit calmer about this? And you also need to think about, since growth has outperformed 5 out of the last 6 years, is that going to last forever? Probably not. Another way of looking at this is to look at the S&P 500, but consider an equal weighted index. So the S&P 500 is what's called a market weighted index, meaning that the larger companies have a greater influence on the index itself. And the larger companies are now the growth companies because they've been growing so quickly. And so you can see how, and this EUSA chart, which is the orange chart here, this is an equal weighted index. So the 500 stocks in the S&P 500 equally weighted. This is an exchange traded fund. You can buy it. So mostly they overlay. But recently, since 23, you can see how the S&P 500 has done much better than the equal weighted S&P 500. And that's the influence of these large companies in the S&P 500, these large technology companies. And you can see how most of the time they overlay. So there could well be a reckoning about this. And that's something to keep in mind, and maybe not be jumping on the bandwagon of technology companies right now. So yeah, investment markets since 2009. Here we're talking about all types of investment markets again. And what I'm trying to point out here is that emerging markets have not done well. So emerging markets are the blue line. They're up about 110%, if you can see that. Obviously, the US stock market up 700%, and even non-US developed markets, the orange line, they're up 200%. double what emerging markets have been up. So this is another theme. Investment markets have just not done well since the 2008 financial crisis. But look at what happened from 2001 to 2008. Well, the orange line is emerging markets in general. The blue line is non-US developed markets, and the purple line here is the S&P 500. So from 2001 to 2008, that was the time when you had the Asian dragons, when everyone was invested in China, and so the emerging markets did great. We made a lot of money in emerging markets in those days. And so what changed? I mean, that's dramatic. From 2001 to 2008, this huge outperformance in emerging markets. And then afterwards, this huge outperformance over the next decade, 15 years really, in the S&P 500 in the US markets. And what changed was basically the financial crisis, right? There's a huge event right there, and that changed everybody's investment perspective. And so here's US versus emerging over 20 years, right? Since basically 2002. And you can see how much more volatile the emerging markets are than even the US markets. And you can also see how they've gone sideways for a long time. So this is another investment theme, because now emerging markets are a lot cheaper than US markets. You look here and you can see at the bottom left, the price earnings ratio for emerging markets, for example, it's about 12. It's about 12. And you look at things like non-US developed markets, the PE ratio is about 14, but then you get to the S&P 500, there you get a PE of 24 now, which is, double the emerging markets price earnings ratio. This is the price you pay for a stock compared to the earnings of the underlying company. And it's a common metric we look at in valuations. And so the US market is twice as expensive as these emerging markets. And by the way, what about the equally weighted US market? Well, that has a PE ratio of about 18, so 19. So a bit less than the S&P, but still quite high. So the conclusion there is that emerging markets are cheap compared to the US market. And the US market overall is not as expensive as the tech component of it. Now, when you want to look at emerging markets, one of the big themes these days is India might be the next China, right? China, we're worried about a number of issues there: property, the communist government, how they clamp down on industry. And so you can see that since the financial crisis, in fact, the S&P has done well. That's the green line. But India is up about 100%, the Indian market, and the Chinese market is down, about 50% really. And right now, it seems more and more people are really putting money into other countries other than China. So that's maybe another thing to look at as you're choosing investments. Another thing is currencies. So currencies since 2007, broadly the US dollar has strengthened. So that's another thing. These are what are called currency shares. They're put out by a company called Invesco. If you want to invest in currencies like the US dollar versus something, that's one way you can go. They trade like exchange traded funds, basically. So these are developed country currencies: the British pound, the yen, the Canadian dollar. And the only one that's really done well is the Swiss franc. That's the one at the top, up 30% since 2007 versus the dollar. But the rest are down like anywhere from 15 to 37%, which is another component of non-US investing, and another reason why the US stock market has done better, because it's valued in US dollars. Over the last 3 years, similar kind of thing. In fact, the one at the bottom there, which is the yen, down 30%. And just recently, maybe that's bottomed out a little bit. So this is another thing to think of going forward, because currencies tend to be mean reverting other than stocks. Over a very long period of time, you wouldn't expect developed market currencies to really go in one direction. You wouldn't expect the US dollar to keep strengthening forever. At some point, it would just become too expensive to buy US products and so on and so forth. And so they tend to be mean reverting, and we've seen a long period of strengthening US dollar here. So that could be another thing to keep in mind. Emerging market currencies, well, those are a lot more volatile. The one you're looking at the bottom is the Turkish lira, down about, down a lot, 95% versus the dollar. So if you're going to invest in emerging markets, this is another thing to keep in mind. Are the currency fluctuations and even possible devaluations, because you buy something on that trades in a foreign currency, you're going to have the currency effect plus the stock market effect. Over the last 3 years, again, Turkish lira at the bottom. Some of these have actually strengthened. Mexican peso at the top, up 17% over the last 3 years versus the dollar. But it's important to keep the currency component in mind. Then commodities. Let's have a quick look at commodities. Gold is down at the bottom there. Gold is a good diversifier, as are other commodities to a portfolio. The top one is oil, obviously, and when the Russia-Ukraine thing kicked off, the price of oil went up, and it's kind of gone sideways since then. But that's done very well over, say, the 3-year time span we're looking at. Other commodities have done kind of a little bit worse than the stock market, but they are good diversifiers. You can see that they don't go up and down with the stock market. The stock market's in blue, the US market. So these are also good diversifiers. Thing about commodities is they don't pay a dividend. Obviously, if you invest in, say, a gold mining company like Newmont or something, Newmont pays a dividend based on the price of gold. So that's another way to invest and get a dividend. But actually investing in commodities, they don't pay dividends. So that's the downside of it. But they can be good diversifiers to a portfolio and certainly worth considering. And many of them you can buy through exchange traded funds like the ones portrayed here, for example. And if there is a war in the Middle East, well, then you might expect the price of oil to go up and probably the price of gold to do well as well. So that's another thing to think about. What about forecasting? Are economists worth listening to, actually? So here are 3 metrics. At the top, you see the S&P 500. In the middle, what we call leading indicators, leading economic indicators. These are things like employment stats. These are for the US. And then GDP, which is something someone talks to, right? The output of a country. And what you're looking at are charts of the numbers off of their highs. So the S&P off of its high. You can see how in 2008 it went down a lot off of its high. And I portrayed them this way because you can see the point I'm trying to make is that all 3 of these are lined up. Look at what the stock market does and look at the leading economic indicators in 2008 and look at GDP. Well, they're all moving at the same time. So by the time the economists tell you, oh, we're not doing well, it's too late. The stock market's already down. So using economic indicators as a forecasting tool is not particularly useful, frankly, because the stock market is itself a leading economic indicator. And so by the time you get around to this kind of knowledge, the moment is gone. What about investing in themes? Well, so for example, the clean and green theme. We've been talking about renewable energy and so on for many years now. But look at how these funds and types of investments have actually done over the last 3 years. So the green one has done well. That's a company called First Solar, but for a long time it wasn't doing that well. It wasn't profitable. And these other funds, these are like a clean energy fund, a global sustainable development fund. You've got Tesla in there. They have really not done very well. The S&P 500 is the brown line that's up 20% over the last 3 years. And you can see these are all the rest of those funds are down 20% to 40%. So clean energy is something that sounds good. It sounds like a great theme for the future, but you really have to pick and choose your investments. You have to think about, are these companies actually making money? Because a lot of them aren't. And the same is true in anything like tech stocks in 2001. Remember the tech bubble, and then it crashed, and then there were some survivors like Amazon, for example. So it's important to pick and choose. And if you miss the initial euphoria about it, then don't jump in at the top on these things. Wait until there are some survivors that you can invest in for the long term. Another theme might be the defense theme since the Ukraine war, and it seems to be conflicts stirring up in various other places too. So how have defense contractors done? And they've actually done pretty well. So the S&P since the Ukraine war is up 9%. That's the line at the bottom. And then we've got BAE Systems, a UK firm, up about almost 100%. Then we've got a few others, Lockheed Martin, Northrop Grumman, that kind of a thing. The aerospace ETF in the middle, all up more than the S&P 500. So here's a theme that actually did well. And the difference between this and the clean and green is that these companies are making money. And so that's what's important to consider if you're investing in themes. Don't just think about the theme itself. Oh, sounds good, I'll put money into it. No. Are these companies actually making money? And by the way, it takes about 2 years for some of these defense contractors to realize profits from some of the contractors they gave. So, we're getting into that point where these might be worth looking at, despite the fact that they've done reasonably well already. We talked a little bit about income investors. I just want to touch briefly on that because we're getting to the end of our time. But there are various ways to generate income from a portfolio. It doesn't just have to be bonds. There's dividend-paying stocks, there's preferred shares, REITs, business development corps. Keep that in mind. It's good to have a diversified portfolio so that everything's not going up and down at the same time. And there are lots of ways to generate income other than bonds. And then let's talk about some expat issues briefly, which is basically some of this has been covered, but tax treaties are important, especially when you have money in tax deferred plans like a Roth IRA may not be recognized under the tax treaty as a tax deferred account, or in the UK, an ISA is not recognized as a tax deferred account for US tax purposes. Things like HSA and 529 plans are not mentioned in tax treaties. So it's important to keep in mind what's going on. Good advice might be an IRA conversion to a Roth for somebody living in the US who's in a low income tax bracket, but maybe not so good for an expat where that Roth is a taxable account. Withholding rules as well on IRA distributions. When you take the money out, make sure, if you're a non-US person, you want to file a W-8 form so that you don't get hit with 30% tax withholding. And make sure you're taking advantage of those tax treaties in terms of the withholding rules. Then there's various other tax type things, PRIPS and PFICs. You've probably heard these terms. PRIPS the PRIPS regulation will limit your access to U.S. exchange traded funds if you live in Europe. If you deal through an American financial advisor, you might be able to get around those, but if you're a retail investor, not so much. Things like currency conversions, Wise, Schwab, Interactive Brokers, they all generally give good rates for currency conversions and transfers. But other banks, you could lose up to 7% if you let them do your currency conversion for you when you're moving money around internationally. Investing in non-US currency, well, Interactive Brokers is great for that. You can invest in investment markets around the world. Other brokerage firms, other US brokerage firms, not so good. Usually you can only invest in the US markets, or you're paying $30 a trade to invest in non-US markets. And then local investments, be aware that usually the markets, especially if you're living in a place like Mexico or other emerging markets, the market is pretty limited, pretty volatile generally, and there could be a currency devaluation at some point in your future. So think about that. Also, they're usually mutual fund-based investments, so higher fees, and you don't have the SIPC insurance that you get in the US. And the final thing is muni bonds. So municipal bonds are tax-free, federally tax-free in the US, sometimes state tax-free as well. But if you're an expat, are these munis useful for you? Because they may be interest on these bonds may be taxed locally if you're living in, somewhere in Europe or somewhere else. And so you don't get the tax benefits, and munis have, because they yield tax benefits, they have a lower interest rate that they pay. So you're getting a lower interest rate, and you're still paying tax on the income locally, maybe. Finally, financial planning topics, and we're running out of time, so I'm not going to spend a lot of time on this. But that's maybe even more important than the investment issues. How do you optimize an income strategy for your financial plan, for your specific situation? What are the expat issues that you face in terms of, say, the withholding rates that we talked about on the other page and so on? What does diversification mean for you if you're spending your money in euros or in other currency and so on? Estate planning considerations as well. If you have a foreign spouse and you're considering a transition of your accounts to that spouse at some point in the future, perhaps, or maybe you have hereditary laws, like in many places, like in France, that affect your estate planning, and minor children that might live in different parts of the world that you need to consider. So financial planning issues are sometimes even more important than the investment issues. And so on that note, just a few takeaways. Bonds offer good value now. and less risk for the first time in years. High yield bond prices are well correlated to the stock market, but investment grade bonds, especially government bonds, offer diversification benefits. Gold and other commodities can also be a good diversifier. A number of income producing investments. You don't just have to invest in bonds. Growth has outperformed value for many years, and at some point there's likely to be a reckoning. Emerging markets have also underperformed, and they're now cheaper than developed markets, but you need to think about country-specific issues there. Economic forecasting, not really useful, because basically the market moves at the same time or ahead of the economy anyway. And then investing in themes can be useful, but always ask where the money is, who's making money, and keep the financial plan in mind. And finally, don't be a slave to behavioral biases. The way people lose money in investment markets, the reason retail investors, self-invested investors, on average do worse than the markets and worse than financial advisors is because they tend to buy high, jumping on bandwagons, and then sell low because they get disgruntled and they see their funds going down. And so don't be a slave to these behavioral biases. Invest for the long term. And so on that note, I think we'll open it up to Q&A, Hugo.
Oh, great. Thank you very much for that presentation, Tom. Loads of fantastic detail and real sort of glimpse behind the scenes at how you work and looking at the kind of historical context, which is really interesting. So we've got some questions here. We haven't got a great deal of time. Let's see if we can get through them. So first one is US Treasuries returns are not federally taxable. So why would one invest in IB funds?
US Treasury returns are not federally taxable. So why would one invest in interactive? Do they mean interactive broker? I'm not actually sure what the question is there. To be honest, so maybe you can reach out to me in person, and I'm just not sure exactly what the question is there.
Yeah, or rephrase that if that's helpful. Whoever left that one. The next one is: if I hold a treasury bond for less than 1 year, does the capital gains rate apply? It's a kind of a tax question, I guess.
Yeah, well, it's a tax question, but yeah, the capital gains component. Is it a long-term gain or a short-term gain? Sure, that's any capital gain. So that's the gain on the sale. Similarly, if it's an ETF or something like that, short-term, long-term capital gains. But bear in mind, if you're an expat, there might be local taxation on this, and typically there's not the long-term capital gains things going on outside the US.
Got it. Here's one. I live in New Zealand. US brokers will not accept clients from New Zealand. If I keep my US investment portfolio under a US address, what will happen? There are sort of different questions here. So the first one, US brokers won't accept clients from New Zealand. Why?
Yeah, well, I think the general thing is nobody wants to deal. If you're in a U.S. brokerage firm, you don't want to. And yeah, it's a problem. Schwab won't deal with people in New Zealand. TD Ameritrade used to, now they got bought by Schwab, and Schwab doesn't want to deal with people in New Zealand. Why? I have no idea. I've asked this question myself. No idea. It's not just New Zealand. It's France. It's Italy. It's a few. Netherlands is another one for some reason. No idea why. Interactive brokers will deal with you. So you can open an interactive broker's account, but they're about the only show in town in terms of U.S. brokerage firms for people living in New Zealand.
So then the next one is about using a US address. Hold on. If I keep my long-term US investment portfolio under a US address, what will happen when I die and my New Zealand address is revealed?
Right. Well, so yeah, and to be blunt, a lot of Americans living overseas, they get around all these problems with brokerages and banks in the US by using a US address. Sometimes you can get away with, a relative's address, or maybe you own a property in the States, or maybe it's just a mail forwarding service. So that works. It doesn't work as well as it used to, because many of these brokerage firms are tracking where you log into. They're tracking your IP address, and if you're logging from the same country, then eventually they'll catch you. And then the other thing is that the reason they want to know where you live is because one of the reasons is that under FATCA, they have an obligation to report on your account to the local tax authorities, maybe, and they can't do that if they think you're living in the US. And so they're not going to be very happy if they find out you're not living there. So it's good to have a backup plan. This is harder and harder to do. With interactive brokers, though, yeah, it depends. If you can't buy ETFs, you're probably living in Europe, because in most other parts of the world with interactive brokers, you can buy US ETFs. It's really a European regulation that affects you there. And if you work through an advisor, at least in your retirement accounts, you can buy US ETFs. We can get an exemption for that. Interactive brokers allows that. But if you've got a taxable account, it's with Interactive Brokers Ireland, for example, then yeah, you're kind of out of luck in buying US ETFs.
So the conclusion is, somebody living in New Zealand, there are options, and it is possible to invest in the US, and avoid local sort of funds that might be, taxed as PFICs. So there are definitely options with interactive brokers, and you have clients in New Zealand.
Yeah, we have a number of clients, and quite a few actually in New Zealand, and I believe they're all with interactive brokers. Yeah.
Okay. So it's an interesting one. Very interesting presentation, a very helpful presentations, they say. And how do you foresee that AI will affect tech company stocks moving forward?
Yeah, I don't know. That's like another one of these themes. There's going to be a bunch of companies coming about AI. It's just going to be like the tech bubble in 2000. Bitcoin's another thing. So the Bitcoin's been around, but now they've started Bitcoin exchange traded funds. Um, I think this AI, you're just going to have to keep your eye on who's making money off of this, actually, because there's going to be euphoria about this. There's going to be people jumping on the bandwagon. AI stock prices will go up, and who's really going to benefit at the end? If you don't get in early on this, just don't get in late on it either. Wait for the sell off, and then solid companies. Probably a company like Google is going to benefit from this. Maybe Apple. Probably it'll be the big players. There'll be some small players as well that'll get bought up, I'm sure. But who they're going to be, I don't know. All I'm saying is don't jump on the bandwagon at the top.
That's interesting. So a couple of questions about IAM. So describe how you work with a client and fees and charges. Yeah, that'd be useful information.
So we're a registered investment advisor in the U.S. How do we work with clients? We don't hold our clients' money. They're held at an independent custodial firm. We use Charles Schwab and Interactive Brokers for our clients, depending on your needs. Schwab's a bank, Interactive Brokers isn't, and so on. So that's where the money is held. We have the authority to manage the investments in the account. We use generally 5 model portfolios and 2 flavors of portfolios, you might say. So 5 model portfolios going from most conservative to most aggressive, depending on the asset allocation. On the most aggressive part, it'll be almost 90% stock market. Most defensive, it'll be 30% stock market. And the 2 flavors are that we offer what we call portfolio management services, which is more for larger accounts where we use more individual stocks and bonds, fewer ETFs. We don't use mutual funds, by the way, at all, because they just add a layer of fees and not much value, frankly. So we use exchange traded funds if we're going to use funds. And then we have portfolio advisory, the other flavor, where we use mostly exchange traded funds. We charge a lower fee for that. The fees go from 1% for the portfolio advisory down to 0.7% for larger accounts. For the portfolio management, the fees go from 1.5% down to depending on larger accounts, go down to 1% or less. So that's kind of the range of the fees. Yeah.
And somebody else, where do interactive brokers hold the investments?
Where do they keep where do they interact? Yeah, that's a really good question, actually. It's not obvious. So generally speaking, this is probably from someone living in Europe. So if you're outside Europe, in most places, you'll be dealing with Interactive Brokers USA, but they also have branches. There's like Interactive Brokers Australia. There's one in Hong Kong, I believe. There's one in Japan. So if you live in those countries, it's probably going to be the local Interactive Brokers. If you live in Europe, that's a great question. If it's a retirement account, oh, by the way, if it's a US retirement account, it's always going to be with Interactive Brokers LLC, the US one. If you live in Europe and it's a taxable account, an individual or a joint account, then it could be with Interactive Brokers Ireland, or they also have entities in Luxembourg and Hungary, I believe. You might ask why Hungary. It's because the guy who started Interactive Brokers, Peterfi, he's Hungarian. That's why. But yeah, that's where they hold their investments. So they could be in Ireland, they could be in the States if it's a retirement account or a U.S. trust. If you live in select other markets where they have a branch, then they could be there.
Somebody else, if one already has a Schwab account, could your company take over managing that? And how much should one have
Yeah.
to invest? So I guess that's minimum.
Yeah, so basically, yeah, certainly, if you already have a Schwab account, it's like a one-page form to transfer it under our umbrella. Your access does not change. You still have access, but we also have our own client portal, by the way, which is quite useful in how we deliver our quarterly reports to clients. But yeah, if you already have a Schwab account or you already have an Interactive Brokers account, it's really easy to transfer them under our umbrella. Mm-hmm.
And just briefly, do you have a minimum amount to invest that you manage?
Yeah, well, we generally, for the investment management side, we generally think of $200,000 minimum, just because, smaller account than that, you're probably better off saving yourself the fees and just putting it into a few funds and so on. For the financial planning service, there's no minimum for that, so you might be interested in financial planning services. Also for smaller portfolios, if you just want some advice, then maybe a financial plan would be the way to go.
Thank you. I would say to Sigrid, who's left a few questions, to reach out to Tom, because your questions, a couple of them are quite sort of specific to your circumstances.
Yeah, he's asking about France, or she, I'm not sure, but anyway, about moving to France. And yeah, there's some nuances there. I think, especially with Schwab, you might be able to keep the accounts. So yeah, I would say reach out to me personally there, and we can talk about what the best way to do that is.
And so, yeah, Tom's available via the website, which is iamadvisors.com. That's iamadvisors.com. I've dropped that into the chat. Hopefully you can all see that. So yeah, if you have sort of personal questions or want to connect with Tom, and discuss your situations, that's do it via that website, iamadvisors.com. Let's just have a look. We're more or less on the hour.
Yeah, there's a contact page there, or by email at IAM as an international asset management at iamadvisors.com if you just want to send an email, or there's a contact page on our website as well.
That's great. I think you answered this, but just one last question that you may have covered already. Can expats using a foreign address buy ETFs from Interactive Brokers?
Well, if you're using a foreign, it depends where you are. If you're in Europe and you have a taxable account, then it's probably your account's with Interactive Brokers Ireland, and they won't let you buy US ETFs. You can buy the foreign ETFs, but that might create a US tax reporting issue for you as PFIX. If it's a retirement account, then you may be able to buy the US ETFs through Interactive Brokers if you're dealing with a financial advisor, because we can get an exemption in those cases.
Well, thank you very much. I'm afraid that's all we have time for today. Thank you again for the fantastic presentation, Tom, and thank you to everyone for joining us.